Let's speak first for a moment just about Pinterest. Actually, both of them, because they're pricing on the higher side of, well, at least in Pinterest's case, the higher side of the lowered expectations. In the wake of the Lyft IPO, how much is that weighing on, you think, all of these IPOs going forward, or was that an anomaly?
I don't think Lyft is an anomaly, and I think that it's important. Investors have trouble with unprofitable companies and valuing them. And Lyft is a good example. So it basically sent a message to the market to be conservative about valuation, because we don't want broken IPOs. Those are technical disasters. They take a while to recover.
Is this a technical disaster in your mind? I'm looking at Lyft on the screen right now.
There's
at $59
no doubt.
a share?
It definitely is. It means that at least the marketplace so far is telling us that it wasn't priced correctly relative to what its valuation should be. And so I consider this, it makes investors nervous.
So let me ask Mike, Nelson just had this, made an interesting argument, which is he said, look, Lyft doesn't really have other comps. There are no other public companies out there that are comparable to what Lyft is doing. Zoom has comparables. You could argue Pinterest has comparables. True?
Right. It's very true. It's software, it's networks, it's ad-supported, it's B2B subscription businesses, whether you're talking about Pinterest or Zoom. And look at the kinds of stocks that have done well right now, right? Growth has beat value. Tech has beat almost everything else. Those stocks slot in there. Now, does it mean there's an overlay of caution about how they're going to be priced and how much they're going to be, people are going to rush in on the first day and feed some kind of a pop? Yeah, I agree with that. But Lyft is, it's people moving other people around, right? So it's not really a virtual business at all. So I do think that there's limits to the comparison, but in terms of the overall tenor of the market, I think it's good that people's first question is this a scary thing? Is it bad that these companies are coming out and pricing above the range? Because that means we're not going to have some kind of a frenzy, and we're going to build this into a bubble, which was otherwise a risk.
Is that a fair argument, though, in terms of this idea that today's IPOs in Pinterest and Zoom have these public comps, and that's a significant differentiator relative to a Lyft, or not in your mind?
I think it does help to have close public comps. But, I mean, if you look at Pinterest, they're trying to argue that they're not a social network. And we are comparing them with ad-based social networking companies. And some would argue that maybe Zoom doesn't have some really good comps. We could look at a broad sector of enterprise software companies. So we have to try to value them the best we can. It is true, ride-hailing is new. I think that when Uber is trying to come out and say, we're a platform, we're different, we're not just ride-hailing. Well, the bottom line is Wall Street's going to look at
What do you think
Lyft.
it's going to do to the Uber IPO? And the reason I ask is, originally there was an expectation that this was going to go out at a $120 billion valuation. When they came out, at least at this latest filing, it was between 90 and 100. By the way, that was after Lyft went public, and at which time I believe the stock was trading in the 70s still. Does that number come down? Does it go up?
We think the number comes down.
Materially?
Well, you could be simple about it. Uber has 5 times the revenue of Lyft. So if Lyft is being valued at $20 billion, then maybe $100 billion for Uber. As Lyft goes down and is valued at $15 billion, I think we get a lower number for Uber. You have to start to then justify why you would change that growth, maybe the wider dominance in the market. So there's things to adjust it.
If you're a viewer today looking at these two stocks, do you buy today, or do you say, look, I'm just going to let these things settle? Do you want them to settle? A lot of these times, by the way, you looked at a Lyft on day one, you would have thought that the train had left the station.
Well, one thing I will say is that we manage the IPO, the Renaissance IPO ETF, and it will include these large IPOs in the index that it tracks. It's a benchmark that shows you how enthusiastic investors are in IPOs. It's traded very well so far this year. I think that it makes sense for investors, especially these IPOs today. Zoom is being priced at 30 times trailing sales, higher than its enterprise group, maybe for good reason, for high growth. Pinterest is now being priced at almost 15 times trailing sales, higher than its group of other digital advertising platforms. It may make sense, even though I think today we're going to see a nice performance in these two companies. But these are going to have to find their way into the marketplace. They're going to have to justify with their reports coming up that they, in fact, are worth the premium to their peer group.
Can you help address what was a controversy in the Lyft IPO, but I'm hearing it even within the context of these IPOs about potential short interest ahead of these things, and how these provisions in lockups exist for investors at the IPO, the idea of underwriters or some of the big banks turning around and offering swap products and other things to hedge funds to short?
I think some of this may be an issue for the regulator.
Okay.
But from our standpoint, the more shorting in the market, the better. We think that the price discovery is a lot better when you have investors that are able to bet on both sides of the market.
I mean, the mechanics of it are fascinating. Obviously, the ethics of it are also interesting. But to me, the message is, if there is such a demand for a synthetic short instrument, because there's all this shadow supply based on lockups, that's your issue.
Right. Is this a new phenomenon, or have people been trying to short at the IPO for very long? Have these synthetic instruments existed?
Yeah, well, first of all, it's hard to find the shares, so it's nice to see the willingness to put together a synthetic instrument. Right. But for example, with the ETF, we're able to short all the positions in our portfolio. That helps reduce expenses for shareholders in our fund. So anyone that is long any of these,
you short them, you lend them out to be shorted.
Lend them out, that's what I mean. We lend them. And so it offsets costs in it. So I think that it's a question of how there are large investors that have always shorted IPOs because they can obtain, they're big enough to obtain shares.
Does it really make a difference whether or not these instruments are made available the first day or not? I mean, eventually there is a full market efficiency when trading this, meaning forces on the short side, once the shares are delivered and they're available to be lent out. Once the options market comes out with options on these, which had gotten sped up in terms of the timing of the release of the options in the case of Lyft, it was only a matter of time before people could find their various instruments to express that view.
That's right. No, I mean, it only matters if you get a really aggressive opening trade pop, as we did in Lyft, and somebody's like, wow, that's the number I want to sell today. No, but to your point, Melissa, I mean, if you have this shadow supply, you don't necessarily know how it's going to trade on that. Facebook bottomed right when the lockup was loosened up, and people thought it was going to be the next leg down, whatever it was, 8 months after its IPO.